Bank of Canada lowered its overnight rate by another 25 basis points, its sixth consecutive cut. Joining us now to discuss the latest decision is James Marple, senior economist at TD. And James, a big worry, of course, is a potential for U.S. tariffs. Why don't you walk us through that?
Sure. Well, the Bank of Canada, obviously, this was how are they going to incorporate this into their outlook? We knew they were probably going to cut rates. They did that. They put out a baseline outlook that did not include any tariffs. No surprise there. We don't know when they're going to come, how long they're going to last, how the Canadian government's going to respond. But they also put a pretty extensive analysis out about how tariffs may impact the Canadian and American economies. What that would do to inflation, to GDP, to exchange rates. And there, as no surprise, it would be a pretty substantial shock to both economies, but disproportionately impact Canada. They had close to a 2% decline relative to their baseline in GDP in Canada under their sort of baseline assumptions. And then, a hit to the second year that continues and onward. So lower GDP growth, lower employment. Again, no real surprise given how our economy is oriented, but also higher inflation. That inflation will rise, and again, that is dependent on the assumption that if the United States imposes 25% tariffs, that Canada responds with reciprocal tariffs of the same amount. And of course, that's how you get price increases on Canadians through the cost of imported goods, where we not only export, but we import a lot from the U.S. There were some interesting tidbits in the analysis. They have the inflation impact building. It builds, slowly over the first year. They have, based on the historical record, that the pass-through of higher prices tends to build over time, with the biggest impact in the second year and into the third year. But they also noted that, we don't know how quickly these things will be passed on. One of the lessons of COVID was that price increases were passed on much quicker. So, dependent on all of that, you could get inflation rising a little bit faster, and you could get different impacts on GDP depending on how fast that increases. But, overall, the results are pretty clear and consistent with what I think everyone has been saying, is that this would be a significant shock to the Canadian economy and would also, with reciprocation, raise inflation.
So obviously we don't know what's going to happen with tariffs. What options would be open to the Bank of Canada in this type of environment?
Sure. Well, it is really challenging for the central bank because, as I said, they want to keep inflation low and stable. That's their primary mandate, but they see that through the lens of, if there's a negative shock to the economy, that potentially puts downward pressure on inflation. But at the same time, where this is a supply shock to the economy, that if we raise tariffs and we have to reorient our supply chain, that's going to put upward pressure on inflation. So it's not clear that they can be the lever to save the Canadian economy, and a lot will depend on how the government in Ottawa reacts to that, what their reciprocal action is, and how they try to support Canadians and industries through this potential shock.
So given the uncertainty of these tariffs, what are some of the other risks to the Bank of Canada's outlook? You mentioned the risk of inflation. Do you see any other risks to the Bank of Canada's outlook?
Well, it's really hard to get away from this, near and present risk of tariffs, which, could come as early as Saturday. But if we could, somehow live in a world where we didn't, we had sort of peace and didn't have to worry about that, I think I'd be watching just for, the signs in the American economy that growth is continuing. That would be very positive for Canada. I'd also be watching for signals in the housing sector, where obviously the decline in interest rates we expect to be supportive of mortgage demand and give a lift to home sales. That should come through in greater housing construction. We'd be looking for signs in the export sector, where there is some increased capacity in terms of pipelines that should allow for greater exports. But those are the kind of risks I'd be looking at. We're not totally out of the woods yet, but it does look like we're pretty close to a soft landing in terms of having inflation come down, interest rates normalize. We should see, as the population growth starts to slow, that we get a little faster per capita GDP growth. That's not totally certain, so that'd be the other thing I'd be watching, is Are we in for a bit of a pickup in productivity? Do we see continued strength in consumer spending, especially these interest rate sensitive sectors?
All right, I want to talk about how the market's reacting. What are money markets telling us about the outlook for interest rates? And does that sort of align with your thinking of where interest rates will be by the end of the year?
Yeah, I mean, we are, markets and our own view is that we will continue to see interest rate cuts from the Bank of Canada, but at a slower pace than we've had to date. That reflects the fact that they are getting closer to what they themselves deem as a neutral rate of interest. The markets are anticipating they push kind of below that, but just to, they're now at 3%. They have a range of 3.25 to 2.25. That puts the midpoint at 2.75. They're almost there. So I think they will continue to cut, but more cautiously. And obviously, again, I mean, it's hard to take too many signals given just how much uncertainty there is around the policy backdrop.
Okay, now another important factor for the loonie is this divergence between the U.S. And Canadian interest rates. Given that the Bank of Canada has been more aggressive in cutting interest rates than the Fed, where do you see the loonie going over the next 12 months?
Sure. Well, it certainly helped, or hurt, I guess, in the case of the Canadian dollar has depreciated due to that interest rate differential. But in fact, if you look across currencies, the exchange rate, the U.S. dollar has appreciated against everyone. And, there was some good analysis even in the Bank of Canada's monetary policy report today that the biggest movement in the Canadian dollar has not actually changed much relative to other currencies. I mean, gaps have widened with other economies and central banks as well relative to the Federal Reserve. But it really has been a risk premium that's driven a lot of the decline in the loonie. And so, again, depending on what we get in terms of tariffs, I would say that's probably the big driver. In the event that we get over that hump and we sort of don't get tariffs, then I would say that the Canadian dollar probably stays around the 68-cent mark and eventually starts to appreciate because the Fed, while slowing, I think will continue to cut interest rates over the course of this year. So we shouldn't see much more of a differential open, and a lot of that's already been priced in. So we have kind of a 68-cent Canadian loonie and eventually sort of appreciating. I would say, though, if we do get a tariff announcement, especially a big 25%, we'll probably see plumb new lows. Like we could see us get 65, even lower on the exchange rate, and that's that risk premium coming through, and also that tariff impact coming through.
Now, obviously, the tariff announcement is something that you'll be watching closely. We'll all be watching closely. Beyond that, are there any other factors that you'll be looking at closely as the Bank of Canada considers its next move?
Sure. Well, watching trends in the labor market, we've continued to see job growth very, very strong, but under the rate of population growth. And, now we have these moving parts where the population should begin to slow as targets for non-permanent residents are brought down. So how that plays out in the job market, and also do we see any signs that the economy is readjusting in terms of absorbing all of this population and hopefully getting a little more income growth, and that the global economy remains supportive. And if all that happens, I think we'll be all right.
James, thank you very much for your time.
You're welcome. Thank you.